No news is good news. Live from New York City this morning. Good morning, good morning. Your equity market positive 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, no ugly surprises from the U.S. inflation report, leaving the door wide open for the Fed to skip June as China considers a broad stimulus package. We begin with the big issue, inflation in America.
You got some downward momentum in inflation.
Inflation that is showing signs of coming down.
The CPI release.
Let's the Fed back off.
You're going to hold the rates where they are.
What we'll see is a Fed that's on hold.
The Fed really wants to buy itself as much time as possible.
There's not that much that the very blunt tool of interest rates can do for inflation.
Inflation is going to be a problem.
I wouldn't say that the inflation problem is solved.
It is going to be lingering in the background.
We're in a world with higher inflation.
Sticky inflation, persistent inflation.
Inflation will be coming down, but maybe slowly.
Inflation can very well can come down very well on its own.
Inflation will dissipate over time.
I'm optimistic.
Inflation will come in lower in the coming months.
It's extremely difficult for the central banks to get a handle on just where it goes from here.
Joining us now to discuss is Morgan Stanley's Jim Karen, Kathy Jones of Charles Schwab. Let's get the reaction, guys. Kathy, first to you, your reaction to that report 31 minutes ago.
Yeah, it was a good report. I think it showed that overall inflation continues to come down. The important categories are starting to show some even more softness in the service sector. Obviously, for the core number, we're still waiting for that rent decline, the housing component to come down. I think that that'll happen in the second half of the year, but that'll be the final move towards a more normalized inflation environment. So I think everybody, the Fed has to be pretty happy with these numbers.
Jim Karen, what's your take?
Well, I think what we were thinking about going into this is that if the inflation numbers come down enough that the Fed goes from a skip in June to a pause and may stay there indefinitely over time. I don't think these numbers were that strong on the downside to inflation, but as Kathy was saying, look, this is a step in the right direction, and certainly it takes away some of the pressure for the Fed. Now, look, the other thing that we also know is going to happen over the coming months is that inflation is going to come down just based on the year-over-year base effect measures, and I'd like to look beyond that. In other words, if all that's going to bring down inflation substantially over the next several months is base effects, then we have to be worried a year from now that those same base effects actually start to prop it up. So when we're speaking a year from today, that inflation may stay sticky at still higher levels.
So Jim, just to be clear, tomorrow, hike, skip, pause, based on what you heard 32 minutes ago.
Yeah, so they're gonna. I think it's a skip at this point, and I think it's going to turn into a pause.
Kathy, you go with the same thing?
Yeah, I think definitely a skip. That's already been communicated. And I'm more optimistic, I think, than Jim about inflation continuing to come down in the second half of the year. The major drivers are starting to ease. It's not just base effects. We're starting to see, real softness, certainly in the wholesale level. That should translate into more softness in the retail level. So I think it turns into a pause after that.
Mike McKee has had some time to go over this data. He can break it down for us now. Morning, Mike.
Morning, John. Well, I called it status quo on surveillance, and I think that's pretty much what it is because it leaves the Fed no change from the idea that they are going to skip. You look at the WIRP function, and Fed funds futures now pricing only an 8% chance that the Fed would raise rates tomorrow. And that's because the headline comes in as expected, up just a tenth, and that pushes, especially with base effects, pushes down the headline year over year. We're looking here at versus expectations rather than versus the prior month, because expectations were key. The core comes in bang on, and the little slight rise in the year over year not going to affect the Fed. This sets us up, according to some analysts, for the idea of a bigger drop in July, because some of the categories that went up are expected to turn around. Gasoline is not expected to turn around, but residences, OER, expected to come down at some point. Used cars were up 4.4%. But the wholesale level, they have come down a lot. And so the expectation is maybe the June numbers out in July will show that they have gone down as well, putting more downward pressure on CPI inflation. And I threw in this one with the airfares, John, because you were talking about it. They are down, not up. And this is, of course, the Powell indicator. This is core services, less housing, and as you can see, another big drop, up just 0.2% on a month-over-month basis and down to 4.6 for year-over-year. So it does show, interestingly enough, that services inflation came down some while goods inflation came up. But overall, the message is inflation is still going down slowly, but still going down.
In what world are airfares down? Mike McKee, not my experience, your experience? Are airfares down?
I think they went up, and now they're still high, put it that way.
And we're struggling to live with it. Mike McKee, thank you. This is the response, the reaction to that inflation data from 35 minutes ago. Equities up by 0.5%, so equities with a lift. In the bond market, as you might expect, yields are lower at the front end by 8 basis points, 2-year at the moment, just short of 450 going into the Fed tomorrow. Euro showing some strength. It was before the number at the other side. Session highs for the euro against the dollar reclaiming 108, 108.14, higher the session 108.24. Jim Caron, there's a quote from you that I wanted to share with our audience. You said the following, and here it is. Global central banks may merge their policy reaction function to the balance of risks, a policy that balances growth and inflation risks. You've gone on to say to justify why they may be unwilling to adapt policy to push inflation down to target and keep it there. Jim, I have to say, are you making the case to be bullish risk based on that?
Well, you know, John, I've been making the case to be at least a little bit more balanced in terms of risk. And I've always said that risk on is a risk and it needs to be hedged like any other risk since the beginning of the year. But the point of that statement was that, yes, central banks want to get inflation down, but it seems like they're failing to get it down to target, and they're unwilling to get it down to, say, a 2% level of target, in which case they're probably not going to hike aggressively enough or keep rates aggressively high enough for long enough to really get inflation down to 2% and keep it anchored at 2%. So while I agree that inflation is coming down, there's no question about that. It's just a question of saying that 2% is no longer the ceiling for inflation. It's the floor. I still think it's going to stay in that 2 to 3% range. It could be a little bit higher, which means that their policy, by definition, relative to their own inflation target, is going to run a little bit easier. And that is going to be supportive for riskier assets. So one of the things that we've done in portfolios and investing is we've tried to stay a little bit away from very interest rate sensitive parts of fixed income. So more leaning towards credit, towards high yield and things like that. And also to the broader equity market is something else that we think that is a good balance to also having some high quality fixed income.
We're thinking about 4,400 now on the S&P 500. You've seen a whole host of characters on Wall Street change their year-end price targets over the last several weeks, starting to capitulate from this view at the start of the year that we'd see 4,000 to a view that maybe we'll see much more than that. Bank of America, new year-end price target, 4,300 was 4K. Evercore, 4,450 was 4,150. Goldman in the last couple of days, 4,500 was 4,000. Jim, making the case to be long equities. That's what you're doing right now. Can you tell me what you're advocating for in fixed income? In treasuries, if you believe this is a Fed that could tolerate stickier inflation and try and support growth, is that high yield to the long end?
Well, the thing is that as long as inflation remains contained or at least still coming down, and there is an expectation that there is going to be a slowdown and possibly even a recession at some point, that's a very, very fat tail risk. So therefore, bond yields have to stay likely lower than even the Fed funds rate for an extended period of time. So that in and of itself eases financial conditions because it just puts more emphasis on riskier assets like equities and even high yield credit and things like that. So I'm not suggesting that we're in a big bear market for bonds. I think bonds are going to do okay. But that's the point. They're just going to do okay. This was supposed to be so far the year for fixed income. Right now, fixed income returns are up about 2%, and equities are up around over 10.
Equities are absolutely ripping relative to expectations. Kathy, that old cliche, we've talked about it on this show before. Capital goes to where it's treated best. Are you getting treated better by equity markets right now or by fixed income?
Well, I mean, clearly the equity market is going vertical here on us. And so good thing I'm not an equity strategist because I don't really have a view on that. But I will say that I disagree with Jim about the inflation targeting by the central banks. I don't see any indication, certainly from the Federal Reserve, that they're willing to give up on their 2% target. And it seems to me that although we may not get a lot more rate hikes, we still have quantitative tightening going on in the background. As inflation comes down, you have real interest rates going up, and that's a form of tightening. So I will take them at their word that 2% is the target. I don't see this Fed and frankly the other major central banks capitulating on the inflation front. So we're a lot more cautious on low quality credit in the fixed income markets. We're more neutral than anything else, but I think there's still some issues, particularly when you look at some of the very low quality credits out there. We still have pretty high real interest rates for them to deal with and high refinancing rates coming up.
Jim, what would you say back to that?
Well, look, I mean, I agree with Kathy. Look, 2% is going to remain the target. The question is, and when I talk about the balance of risks, is are central banks willing to do what it takes to actually get the inflation down to that target level? That would still argue for substantially higher policy rates in order for them to do that. Now, yes, there could be a broadening as services inflation is coming down and things like that. All of those things are happening. I guess I'm a little more skeptical than Kathy is about how low inflation will go and will it stay there and will it be anchored at around that 2% level. My view, and I know I'm counter consensus on this, but I believe that inflation is going to be unanchored at 2%, and it's going to likely try to percolate higher just given the strength in the jobs market and what have you. And this is not just a U.S. issue. This is global. I mean, Bank of Canada increased rates last week outside of expectations, 25 basis points. The RBA, everybody's having a hard time getting inflation down to those target levels and keeping them there. And this is what's creating some of the issues. So the balance of risks are you either kill growth and solve the inflation problem, or you let inflation run a little bit hotter above target and try to manage to have decent growth. And I think the central bank's going to err to the side of growth, which is what makes me a little bit more balanced in my outlook for owning some risky assets alongside some high-quality fixed income.
So, Jim, just the last question in this segment to you. When do you think the $5 trillion worth of money in money market funds get the joke?
You know, that is the $5 trillion question. that is a very, very good. You know, I think that, you know, cash rates at around 5% still are attractive. That's, you know, that's pretty good. But I think that there is going to be a chasing of returns. And I think that some of that capital is going to start to leak out. I think it's going to leak out when the market breadth broadens in the equity markets for performance to be more widespread as opposed to mainly just in tech, which I think people already see it up 35% year to date. Might be a little bit hard to chase at this point, but the other sectors might start to look more appealing that have better valuations, P multiples around 15.
Jim Caron, Kathy Jones sticking with us. Two very different views on the path forward for central banks here. Equities right now up 0.6% with some movers ahead of the open. Here's Abby.
Hey, John. Well, the AI craze is back, and this has Oracle poised to open at a record high. Shares are popping sharply higher. This after they put up 54% cloud growth in their last quarter. That drove a top and bottom line beat. And it's the AI, the generative AI, that's really driving that cloud demand that they expect to stick around. In sympathy, we have lots of the other AI-related names higher, including NVIDIA. And then finally, one for you, John. Manchester United up 12.4%. As you know, there was a tweet from a Qatari newspaper that spurred speculation that the Premier League football club may, in fact, finally be close to being sold.
Abby, thanks for that. More on that around the opening bell. Coming up, China said to be considering a package of stimulus measures.
Chinese inflation is very low. Chinese exports aren't doing that badly either. What Chinese policy needs to do is get domestic demand going.
That conversation up next.
As with China, everybody is super pessimistic on Europe. There's not, in a call that we had, it was on China, but, my colleagues are saying that they don't know of anyone who's optimistic. And when the market is that one way, it's not the question of is the economics right or wrong. The question is, have the expectations overshot? What Chinese policy needs to do is get domestic demand going. So I think they're letting the market take dollar CNH up, but without particularly endorsing it.
The team over at Standard Chartered saying we're too bullish on the United States, too bearish on China. This as China is said to be considering a broad package of stimulus measures as pressure builds on Xi's government to boost the economy. According to people familiar with the matter, proposals include rate reductions and at least a dozen measures designed to support areas such as real estate and domestic demand. JP Morgan has its doubts. Mislav Matejka writing, we believe China will keep stalling in the second half with hopes of any material stimulus likely ending up unfulfilled. Bloomberg's Ender Curran joins us now from DC for more. And what are you, the team, what should all of us be expecting from China in the next few weeks?
Well, it's a question of what options they have, John. As you mentioned, our colleagues in Beijing are reporting that they may look at ways to bring down mortgage costs. They may look at ways to boost the housing sector there because the expected rebound in housing isn't really playing out at all or softens across the board there. And of course, the consumer demand story, that was meant to see a big rebound after the end of COVID zero. That isn't necessarily playing out as expected either. The problem is that the authorities are somewhat boxed in. At the local government level, there's a lot of debt. At the property developer level, there's a lot of debt. The authorities are very keen to keep a steady hand when it comes to debt and leverage. So it's a question of what they can do. Now, what they are doing is bringing down some interest rates. The central bank again brought down another short-term interest rate overnight. But not a lot of people think that lower interest rates is what China's economy needs. It needs a big rev up in animal spirits.
And what went wrong? 6 months ago, we were talking about China reopening, China booming, lifting the rest of the world, get long Europe, buy European equities, luxury players. That all ripped and then it faded, it broke down. What went wrong? Why are we sitting here in June talking about the need for stimulus in China?
And it was meant to be the big upside surprise story for the global economy this year, John. I mean, some sectors have performed somewhat okay. There has been some demand for luxury goods, for example. But broadly speaking, I think it's the animal spirit story that has been missing. Post-COVID zero, we were meant to see a big rebound in consumer spending. It hasn't really happened. Maybe that's because in 2020 and 21, China's economy had a pretty good run, don't forget. During the depths of the pandemic, the export market was going gangbusters. The internal circulation story was doing fine because there was no COVID in China. So perhaps it was never going to be the V-shaped rebound that other parts of the world have seen. But whatever, the end result is trade and manufacturing are pretty much in the doldrums. The consumer rebound story seems to have petered out. The overseas travel story certainly hasn't happened in terms of the dividend from Chinese tourists. So it looks as though it's all down to what the public sector can do now to get China's economy back on track for the second half of the year, or else it will be a pretty disappointing 2023 for China's economy.
Surprised in 1,000 different ways through 2023 so far, only halfway through the year. And thank you. Jim Kerr and Kathy Jones back with us. Kathy, any assumptions right now? Any working assumptions from your perspective and the team on what might come out of China in the next few months?
Oh, yeah, we're just trying to work on it now. And I think our assumption is that they will try to take some measures, but they're in so deep on the debt side and the real estate sector, and it's probably going to take a lot to dig out of that. So we should see some easing. But, with China, you just never know how much can get done, how quickly, the way it distributes through the economy. And they've taken more tentative steps, I think, over the last year than most people expected. So we're still a little bit cautious about just how far they're willing to go.
Jim, are you cautious too?
Yeah, we're cautious. Now, look, I think the issue with looking at China is that we look at it from a developed market lens. What we have to understand is that China's having an internal demand problem, right? They don't have internal demand. They're a large open economy. Their economy functions on external demand. The solution of rate cuts is a demand side solution. If I said, hey, the U.S. is slowing down, we cut rates, you increase internal demand, we get the economy back going. China doesn't have as much internal demand. So cutting rates doesn't actually generate that demand to generate the growth. That's a very developed market way to kind of think about how cutting rates could actually work. So as Ender Curran was just saying, it's like we're missing those animal spirits. That's the problem. That internal demand component has never really been developed in the Chinese economy. And that's why their policy is of cutting rates is going to be very, very really stressed or challenged, at least, to try to generate the GDP growth. They have debt overhangs. They have all these various issues. Lots of countries do. There's no question. They have a lot of money they can stimulate. But I think what they end up doing is going back to their external demand model to generate the growth, because that's what's worked before. And that's what's worked, obviously in the past and has worked well. And that's something that I think for the global economy could actually be somewhat supportive, but they're not there yet.
It's been so surprising to see what develops there, and I think we've all been surprised by 1,000 different things, as I was saying to Enda Curran just moments ago. I was writing yesterday evening how each and every month of 23 so far has been different to the other. In January it was soft landing, then it was no landing in February, hard landing in March, April, all thinking about what would happen with a credit crunch. Surely it will come. Then in May we saw this rally in equities. It was just about big tech, and here we are in June talking about a bull market. Kathy, I was looking at your mid-year outlook and this line from you. As we close the books on the first half of 2023, what stands out is how much didn't change. Kathy, I'm talking about what did change. What stood out to you that remained the same?
Well, what remained the same was Fed policy and yields from 2 years on. So we saw all the movement at the short end of the curve. We saw huge volatility in fixed income, so that MOVE index was at really elevated levels because of the banking crisis. And yet here we are with yields from 2 years on out, just about where we started the year, and actually a little bit lower as you go out the curve. So what didn't change was monetary policy, and what didn't change was the yield curve, the market's reaction to that as you go out on the yield curve.
Any reason, Kathy, to think it changes anytime soon?
No, I don't think so. I mean, I think yields will drift down from here. That's our forecast for the year, and has been from the beginning of the year, that we'll see, 3.25% or so on the 10-year, because we do expect inflation to come down. We do expect that the economy will slow down. There's still a risk of recession on the horizon, depending on just how tight monetary policy squeezes. And we have the fiscal impulse, which is now negative, not positive. So maybe we get a lot of boost from external sources. Maybe China contributes to economic growth globally that helps out the U.S. economy. But the trajectory we're on is still slow growth, lower inflation, probably higher unemployment down the road, and that translates to us to lower yields.
Kathy, great to catch up. Great panel this morning. Kathy Jones there and Jim Caron. Going into the opening bell about 7 minutes away. Equities up here by 0.4%. Coming up the morning calls and later, turning us back on the equity market rally, why Richard Bernstein of RB Advisors is looking outside the US for investment opportunities. That conversation still ahead. Your opening bell 7 minutes away. 4 minutes away from the opening bell. Equities up by 0.4%. Let's get you some morning calls. First up, Morgan Stanley upgrading Urban Outfitters to overweight, $41 price target, highlighting the stock's attractive valuation. UBS downgrading Apple to neutral, saying recent data checks indicate softening iPhone demand. And finally, Goldman upgrading Oracle to neutral, pointing to the company's solid results and continuing cloud momentum. That stock is up by 5.4%. Coming up, pushing back on the rally, Richard Bernstein of RB Advisors explains why this time isn't different. Your opening bell up next. Three-day winning streak on the S&P 500, about to become 4 at the opening bell. Equity futures right now up 0.3%. Absolutely nothing to be scared of in that inflation report, according to many of you. Pushing equities up on the Nasdaq by 0.75%, and the rally resumes on a Russell up by 0.27%. There's your opening bell. Switch to the board and get to the bond market. Off the back of that CPI report 1 hour ago, to the second, yields lower by about a basis point or two on a 10-year, 372, 371.83 to be precise. Dollar showing some weakness, euro some strength, back through 108, 108.04 in that currency pair, and crude higher by 3 percentage points, trying to recover and reclaim a 70 handle, $69 and about 20 cents right now. About 20 seconds into the session, your equity market shaping up as follows on the S&P 500, positive by 0.4%. On the Nasdaq, up by 0.7%. I can tell you the Nasdaq year to date up by 35% on the Nasdaq 100 year to date so far in 2023, and 6 months still to go. One stock to watch at the open is Oracle. Shares hitting a record high after the company reported better than expected results. The CEO, Safra Catz, writing, quote, "Both of our two strategic cloud businesses are getting bigger and growing faster. That bodes well for another strong year in 2024. Abby has more. Hey, Abby.
Hey, John. And it's interesting because that strength may not bode so well for Amazon and Microsoft. At least that is one of the pieces of commentary coming out of the street, that they put up such a strong cloud quarter, 54% growth in the quarter, driving both the top and bottom line beat, that the competitors, they may have a reason for pause. Now, looking forward, they expect to continue to see this kind of demand for the cloud, for the generative AI. And it wasn't just Goldman that's positive. You earlier were mentioning that they upgraded the stock from a neutral or from a sell to a neutral, no small thing. Piper Sandler saying solid execution, improving cloud growth prospects. D.A. Davidson, interestingly, saying they may be a little bit of ahead of themselves on their outlook because they are so positive on their cloud business. But Jeffrey saying that the cloud is the highlight of the results and the stock has room to grind higher on continued execution. So a record high here, maybe more to come, John.
Abby, thank you. Oracle up by 5.5%. Yesterday, record high on Apple. This morning, pulling back just a touch from those all-time highs. UBS cutting the stock to neutral, writing the following: we're downgrading Apple given persistent softness in developed markets and data that indicates growth is likely to remain under pressure. We do not believe Apple shares offer a compelling risk-reward, particularly in light of soft iPhone, PC and App Store fundamentals over the next 6 to 12 months. Not taking a big dent out of this rally. Not even taking a bite out of it, really. We're down by 0.3%, but notable this morning to see anyone downgrading Apple after a 41% surge year to date. That's the Apple story. Let's get to Manchester United, surging at the opening bell. This coming after a tweet from a Qatari newspaper spurred speculation that the team is moving closer to being sold. Isabel Lee has more. Hey, Isabel.
Hi, John. This has been going on for a while, around 7 months to be exact, and sports fans all over the world are very invested. In pre-market, it was trading as much as 30%. Now it's paired gains around 13%. Reports swirling overnight has sent the stocks soaring. So we have the Qatar Sheikh Hassim saying that it might be a success, this bid, and this is the 5th takeover offer for the Premier League team. He made it clear last week that this is the last time he's going to make a bid. Details are sparse for now, but reports say it's around 100% of the club. Hassim is the son of Qatar's former prime minister. His rival is British billionaire Jim Ratcliffe. So as of close yesterday, Manchester was valued at around $3.8 billion. So we'll see where it goes for now, John.
It seems like shareholders and fans alike do not want the Glazers retaining any kind of minority stake in this business. Isabel, thank you. And like Isabel, I've been struggling to follow this one. It feels like it's been going on for absolutely ages. Any clarity on that story? We'll try and bring it to you. Let's take a look at cruise line stocks this morning. Carnival, Royal Caribbean, Norwegian all moving higher. JP Morgan and Bank of America touting industry momentum and increasing confidence in consumer demand. Bank of America analysts saying, quote, the cruise industry's long booking window and strong current demand could allow it to be less susceptible to a slowdown in the leisure consumer relative to other areas of travel. Katie has more. Hey, Katie.
Hey, John. Yeah, Carnival leading the big three higher once again this morning, currently looking at gains about 1.3% after that double upgrade that you mentioned from Bank of America and JP Morgan yesterday. Now, both banks also lifted their price targets for the likes of Royal Caribbean, Norwegian yesterday, in addition to upgrading Carnival. And like you said, this all really comes back to the fundamentals. JP Morgan in particular sees the cruise industry enjoying continued demand momentum after meeting with each of those cruise liners. Bank of America analysts had the same takeaways from those meetings, writing that industry demand is steady and the pricing environment is, quote, rational. Now, if we take a look at the stocks on a slightly longer time frame, after a little setback in March, cruise stocks have been soaring over the past month and a half or so. Royal Caribbean is the year-to-date leader with 2023 gains of over 90%. But Carnival in orange there, as you can see, it's quickly catching up. Norwegian, still the relative underperformer, but still year-to-date gains of 50%, John.
One thing you'll never catch me doing. I talk about this all the time. Katie, just hate a cruise. Just the idea of it. I despise the idea of it. But clearly you should not listen to me based on the year-to-date performance, Katie, that you just described.
I would also never get on a boat that big, so you'll catch me
and then
on
be
land.
Stuck there with, anyway.
Not me.
Katie, thank you. Not me either. It's good to hear. Meanwhile, Tesla looking to extend its record rally to a 13th session, coming off another analyst record upgrade, this time from KGI Securities, boosting shares to outperform and writing Tesla's automotive investments in the US are paying off. Its AI prowess is underrated. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. We have extended Tesla's streak to a 13th straight session, extending the record run of gains that the stock has seen. KGI's upgrade is one catalyst. There was also a note from Morgan Stanley late on Monday saying that it's time for Tesla to start thinking about a financial services arm so that in the next 9 to 10 million customers that they try to acquire, quote, they can give more optionality around monthly lease payments as opposed to outright cash purchases. You also will have seen the news on Monday that a number of charging companies in quick succession put statements out saying that they would adopt Tesla's North American charging standard as an option for their customers at their charging stations, that continuing to be a point of focus for Tesla, really, and what kind of a business they can evolve for themselves in opening up their network of chargers, fast chargers or superchargers, to peers and rivals, and seeing the pressure that some of the charging infrastructure rivals are under. We're up more than 107% year to date. Tesla, a stock up 107% year to date and extending that to a 13th straight session, which is a record, John.
Ed, thank you, mate. What a run. Up another 1.7% to 254. Here are the scores month to date in June. Tesla's been flying all year, but we've seen clear outperformance in small caps, regional banks, going against the grain for 2023. It is the debate of the moment. Can the equity market rally continue to spread beyond mega cap tech and AI hopes and dreams? David Costin of Goldman Sachs raising his price target coming into this week, explaining that, quote, prior episodes of sharply narrowing breadth have been followed up by a catch-up from a broader valuation re-rating. Marko Kolanovic over at JP Morgan pushing back, acknowledging that the real pain trade in the market is the breakout driven by cyclical value, but we do not see it getting confirmation. Any China stimulus is unlikely to be meaningful. PMIs could converge, but with services coming down towards manufacturing in the second half. Richard Bernstein of Richard Bernstein Advisors joins us now. Richard, wonderful to get your perspective and catch up with you, sir. It always is. Let's start with June. Is June going to look like the rest of this year?
Well, the way we're positioned, John, I certainly hope not. I think that we're in some kind of a speculative burst here. One could argue as to, how broad that is or how big that is or how long it's going to last. But I think, some of the things you've been talking about certain stocks going up abnormally, huge runs. This is not what bull markets are made of. This is a very narrow, tight, speculative leadership.
We're starting to see it spread, though, Rich, through the month so far in June, to regionals, to small caps. Is there reason to believe that there's something there, something bigger?
Oh, I think that's certainly a healthy sign, but I don't think that we're seeing. We're basically seeing a pricing in of the perfect soft landing. I think that's kind of what we're seeing here, and I would argue the probability of that happening is actually the lowest of the three outcomes, whether we either have an economy that's much stronger than people think, an economy that's much weaker than people think, or economy that's just right, the Goldilocks scenario. I think the Goldilocks scenario is the least probable of those three, but that's what's being priced in. And so, yes, you are seeing some broadening of the market, but I don't think we should call this a broad market.
This is what Stuart Kaiser of Citi's got to say. Economic growth is likely a necessary condition for a sustainable rotation into cyclicals. It's all been about scarcity of growth for him in the equity market, and to reverse that trend, growth would need to no longer be scarce. Now, Rich, looking forward, there are these hopes that China delivers some kind of stimulus package. We at Bloomberg have reported on that, the prospect of it, the proposals that are on the table this morning. JP Morgan does not sound optimistic about stimulus in China. Others have pushed back as well about what kind of effect it would have. Richard, are your hopes for rest of the world outperformance pinned on what China may or may not do in the next few months?
Well, John, first I want to remind everybody that it was my group at Merrill Lynch that 30 plus years ago first discovered that growth outperforms when growth is scarce, when earnings growth itself is scarce, and that value outperforms when growth is more abundant. So I think there is something to that. But I think what one has to realize that the leadership that we are seeing and the idea that only 10 or 20 stocks can grow is such a dire forecast of corporate survival going forward that it's kind of silly. It's not like the Nifty 50 anymore. It's the Nifty 5 or the Nifty 10. That is such an incredibly dire forecast and says that there are no growth opportunities anywhere else in the world, not only in the sectors in the United States, but anywhere else in the world. That seems way too bearish to me. I don't think that people understand that the focus on the top 5, 10, 15, 20 names as the only growth opportunities is an incredibly bearish view of the global economy. And we're just not that bearish. I mean, people say we're bearish because we don't like the top 5, 10, or 15 names. But in fact, we're actually quite bullish on the global economy relative to people are thinking. So I don't think it's just China. I mean, estimate revisions in Europe are leading the world. So this is not just a China story.
Anyone, Rich, who missed out on the 35% rally of the NASDAQ 100, by definition for some people, apparently is bearish. So, Rich, let's talk about the opportunities outside of America. Europe right now challenged by the slowdown in China. They can't reopen twice. We're talking about stimulus now. Can you answer directly, does that rest of the world outperformance, does that story of the rest of the world economic growth picking back up again, does it require stimulus from China?
I don't think it requires just stimulus from China. Certainly, the more that China is going to stimulate, the better the story becomes, of course. But I don't think that's the case. I think it's pretty well known that China's been limping along for a while. But yet, as I said, earnings revisions in Europe are the strongest of any region of the world right now. And I think people know that China's limping. So I don't think it's totally dependent on China. And in fact, the other side, John, is that whether you're in China, remember, China sells at about a half to a third of the valuation of NASDAQ. The issues that we know about China, the issues that we know about Japan, the issues that we know about Europe are pretty well discounted into stock prices versus the very high valuations for those top 5, 10, 15, 20 names where it's like a perfect outcome is already embedded in the prices, rather.
Standard Chartered agrees with you. They think we're too bullish the US, too bearish China. So, Rich, let's put some trades on it. How would you express that view right now? Through equities, foreign exchange, what would you do?
So John, we actually have it at my firm, Richard Bernstein Advisors. We have our lowest U.S. weight in the history of our firm. We have never had this low weight for the U.S. relative to non-U.S. 10, 15 years ago, we had 80% of our equity weight in the United States. Now it's probably about 45 to 50%, depending on the particular portfolio. So I think that's number one, right? That people should be looking outside the United States. Do not be geographically myopic. Number two, I think, look, if you think the economy is going to rev up, if you think inflation is going to come back, clearly you want to play more commodity-oriented sectors, commodity-oriented countries. If you think the economy is going to slow down more than people think, then it would be traditional defenses. But as I said, I have a very tough time understanding the love affair with the top 5, 10, 15 companies that need the perfect slowdown, the perfect soft landing.
Well, Rich, the rest of the world's a big place. What are we talking about here? Miners in London, energy players across Europe. What are we talking about? Tech over in China, Japanese equities, banks, what?
Well, I think one has to remember that in Europe, the two biggest sectors are energy and consumer staples. So, one of the reasons we like Europe is just simply those are the two dominant sectors there. If you're looking at Japan, Japan's market is very related to a weak yen. If we go back 30 or 40 years ago, there was no relationship between the Nikkei and the yen because the Japanese economy was so productive, the currency didn't matter. Well, we know the Japanese economy is not a productive economy because of their demographics and other issues. So now they're very dependent on a weaker yen. They can only compete based on currency, based on price. So the weak yen, which we have seen, is boosting the Japanese equity market as it has been, through multiple cycles. So I think there's a number of different ways to play this around the world. As I said, I think the world is very, very attractive.
Richard Bernstein making that point several times. We'll continue this conversation another time. Richard, it's good to see you. From New York City, this market positive, 0.7%. Call it whatever you want. We're up more than 20% from the lows of October. A lot of people would call that a bull market. On the NASDAQ, up by 0.75%. Inflation data, 1 hour and 14 minutes away. Nothing really too ugly in it relative to expectations going into the Fed tomorrow, leaving the door wide open for them to skip, maybe even pause and stop hiking interest rates. This from the president just moments ago. The CPI report shows progress on fighting inflation. Coming up, the former president heading to court.
We obviously take very seriously our responsibilities to protect classified information and to protect the nation's secrets. And what we're focused on is doing exactly that.
That conversation up next. Equities up this morning about 18 minutes into the session, positive by 0.5%. Big spectacle later on this afternoon. The former President Donald Trump set to appear in a Miami court after being indicted on 37 counts for allegedly mishandling classified documents after leaving the White House. Joining us now, the Bloomberg team, AMH in D.C., alongside Kenny Lyons in Miami with more. Kenny, just walk me through the next 6 hours.
Well, President Trump is expected to appear at that federal courthouse at 3 p.m. Eastern time. We may not actually see him arrive. He is likely to walk in via an underground tunnel. But what will happen once he is inside is he will be arrested and then processed. He could potentially have his fingerprint and mugshot taken. He could even potentially have to forfeit his passport. Then he will head up to a courtroom on the 13th floor, we understand, appear before a judge and plead not guilty because, of course, he has maintained his innocence related to these federal criminal charges. 7 charges in total, 37 counts of them. And, of course, this is the first time in history a president will have been arraigned related to federal criminal charges. As for who will be with him in the courtroom, we understand it'll be his existing attorneys, Todd Blanche and Chris Kice, after he unsuccessfully attempted to expand his legal team with a qualified lawyer down here in South Florida, despite interviewing potential candidates all afternoon yesterday. And then, of course, there will be who potentially could be outside of the courtroom. In addition to all of us journalists, there could be as many as 5,000 up to 50,000 protesters in Miami today, according to the police chief. Of course, President Trump has called on his supporters to come out and peacefully protest today, but security will be intense for any potential violence. And then, of course, once the events here in Miami wrap up today, President Trump is getting back on the plane to Bedminster, New Jersey. He will hold an event at his golf club there this evening, speaking at 8:15 p.m. Eastern time, and then having a donor event. The campaign expects he could raise $2 million tonight after making history with this federal agreement in Miami this afternoon. John.
Back on the campaign trail, AMH, Governor Christie making comments, Nikki Haley making comments. What are they saying?
Well, you're starting to see the rhetoric really heat up against the former president, and the criticism when it comes to Chris Christie. We were all expecting this, given how we know he has spoken about the president recently. But this town hall, Jonathan, he said it was an ego run amok, vanity run amok, and he said he hasn't won a, quote, damn thing since 2016. He's a 3-time loser, and then repeated it. Loser, loser, loser. That kind of rhetoric is now seeping into the campaign trail. And then you had Nikki Haley, Jonathan, the former president's own UN ambassador, yesterday really start to amp up her criticism as well. She talked about the fact that if what she saw in this indictment, if it were to be true about the handling of classified documents, talked about the fact that it would put, and she's a military family, it would put military men and women at risk. And she said it was reckless, Jonathan. Also, Tim Scott, while again he went after, quote unquote, what they would call Biden's justice system, many want to try to politicize this on the right. He did say it is a serious allegation, but then, of course, made sure he mentioned that you are innocent in this country until proven guilty.
Katie, let's finish on this. Legal representation. Do you have a better idea at this time this morning as to what kind of legal representation the former president has?
Well, we understand that it'll at least be his 2 attorneys that he still had maintained even after 2 others resigned after this indictment came down last week. That would be Todd Blanche and Chris Kice. But his attempts yesterday afternoon after arriving in Miami to get an experienced lawyer from South Florida who would be qualified and willing to represent him proved to be unfruitful. Of course, there are a lot of attorneys who seem like they don't want to touch this case either because of, even though it's high profile, because of the ramifications potentially of losing it. And of course, that indictment that was unsealed on Friday is pretty extensive, has photographs, has actual taped conversations between President Trump and others regarding these documents. And a lot of attorneys we've spoken with here at Bloomberg think that this is a pretty powerful case for the prosecution. Maybe there aren't many that are eager to go up against it.
Kelly, thank you. Down in Miami, alongside AMH in Washington, D.C. Looking forward to the coverage from both of you coming up a little bit later on this afternoon. Let's get you some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Well, we're looking at a bullish sector composition, not surprisingly, with the S&P 500 heading to its 4th up day in a row, the longest winning streak since early April. Energy, materials, both up more than 1%. Financials up close to 1%. So we're broadening out that breadth that analysts are looking for, strategists on the street, away from big tech. As for the tech sector on the day, it's interesting because earlier I had an alert on NVIDIA, almost briefly in that $1 trillion club, but back below it. But you can see that Oracle hanging on to some of those gains. Tech overall underperforming some of the winning sectors, up 0.4%.
Abby, thank you. Your trading diary up next. No news is good news for this equity market. No real news in that inflation report relative to expectations. Equities up and small caps outperform on the session and on the month. That's the price action. Here's the trading diary. Secretary Yellen testifying before the House at the top of the hour, plus President Trump due in court in Miami this afternoon. Fed rate decision, Chairman Powell news conference tomorrow. US retail sales, claims, and an ECB rate decision on Thursday. And finally, a rate decision from the BOJ and UMich sentiment survey to close out the week on Friday. That closes out this morning for me. Good morning. This was the countdown to the open. This is Bloomberg.